Good evening, everyone. Welcome to another session, our second session in the Venture Foundry series. Thank you so much for joining us. You can just give us a thumbs up to make sure that we are audible, and then we are going to get started. Lovely. And for everybody who's joining us, please do introduce yourself in the chat box. Let us know who you are, what you do, and maybe what you expect from the session. So some housekeeping rules. Let me introduce myself first. I'm Tigi Saki, and I'm the marketing and comms lead for Savant Foundry. So I am going to ask all of you to please stay on mute. You are more than welcome to switch on your cameras so that we know that it's not AI, it's actually you. Would love to see those faces and engage. Please do note that we will be taking questions. Hi, Nick. Please note that we will be taking questions at the end. So if questions come up during the session, type them in the chat so you don't forget, and then we'll respond to them later. I will not, unfortunately, be admitting any AI. We'll be sharing the recording with you after this. Yeah, so that's it for me. And please do enjoy the session. I will hand over to Mr. Tabelo.
Thank you, Mtsiki. My name is Mr. Tabelo, since Mtsiki has mentioned. I'm CEO of Savant Foundry, and it's exciting to have everyone here on the call today. This is our second webinar on the series, and we really appreciate and actually respect your presence in this session. It's important for me to explain how the structure or how the webinar is structured. So it will start with me just really introducing the format on how we'll do it, and that will take around 5 to 10 minutes. Then the second speaker, who's our guest speaker, Lundi Njomane from Jozi, will be coming in for around 25 to 30 minutes. It will deliver he will present his PowerPoint. The idea is to ensure that everyone listens to what he's presenting. Then at the end, we'll have a Q&A session where we'll be in a position to either from him, if the questions are too difficult for him. It's good that today we've got people from Savant as well. Then we can answer your questions as they come. The idea is to build a cohesive and progressive ecosystem, entrepreneurship and innovation ecosystem. We have seen how founders struggle with accessing, call it venture support, whether financial or non-financial. So the idea for this webinar series is to ensure that we can bring together different role players, people like the Jozi Angels that are here today. Last session, we had somebody from the Technology Innovation Agency, and potentially next month, we'll have somebody from Absa Bank. The point, as I've mentioned, is to ensure that we engage in this. It's centered around founders and founder needs. Very important that when we ask questions, we obviously ask those questions with respect. We know that sometimes innovation and entrepreneurship can be very frustrating. So without wasting any further time, Ntsiki, you'll check for me if Francois is here. If he's not, then we can bring him in later on. Today, we also brought Francois, who's from Savant, my colleague. He will be talking about the BUILD program, which the call is currently out. He will then give you more details on how that program can potentially help what you're doing or the people in your ecosystem or network. Without wasting any further time, Mr. Lundi Njomane, over to you.
Thank you so much, Tabelo. Thank you so much, guys, to you and the Savant team for the invitation. Let me share my screen, and perhaps before I even get started on the presentation side of things, a little bit of background and context in terms of who I am. So I've been in the venture capital space or the early stage investment space for, about 16 years now. got into the space initially looking for funding myself, and then found myself, not knowing where to go for certain pockets of money. Typical institutions like your government-funded funders were the route that I would take. And then at a later stage, I bumped into a family office, and that family office was essentially getting started within the venture capital space. And then they invited me as an entrepreneur in residence, and then I kind of took a seat on the other side of the table. So broadly speaking, I've got a little bit of context from the founder side and a little bit of context from the investor side as well. And that essentially is a collection of the insights that I've been able to kind of bring. And along the journey, I also then joined as a partner within Jozi Angels. And essentially what I'm presenting today is what it is that it means to be an angel investor and what angel investors are actually bringing to the table. So I think departure point, it only makes sense to ask what is angel investing? So the first thing that one needs to consider is that my slide is not moving. Give me a second.
Well, it was moving earlier.
I
So
know it's the gremlins, like I'm not even understanding. There we go. Okay. So firstly, what is angel investing? So it's individuals that are coming in and bringing in their own individual like investment capital. So this could be people that are working and are earning typically quite well, and they're looking to diversify their source of investments. And it could be individuals that are running their own businesses, or it could be people that have received good pockets of money from inheritance. So the pools of money, they come from different directions. But at the end of the day, it's individuals who are then making decisions in and of themselves to participate within this particular space. And they act as the first style of institutional capital that your early stage tech startups or businesses, for that matter, would want to attract. And when I say institutional style, it's because it is formalized in how they get into a relationship with the companies that they invest in. So it's not just giving money as maybe someone might who might be a family member to say, here's 50,000 Rand as an example. Let's give your business a try and see what happens to it. And within that investment itself, there aren't any processes that one would need to go to. So within these individuals participating, there's certain processes that are in place to guide that particular investment. Now, the angel investment asset class or the angel investment side or investor in America is completely different to what it is that you might find in South Africa to a certain extent. The reason why I say different is because a lot of the companies in South Africa or the startups or businesses in South Africa, they don't necessarily have friends and family that might be able to invest certain amounts of money. Typically in America or the Western world or more developed markets, you're going to have friends and family who are able to provide significant amount of capital in order to get a business going. So in South Africa, sometimes that angel investor becomes almost like a friends and family type of investor to that particular business, because again, they're coming in as an individual investing into that company. But again, as much as they're coming in as the individual that they are that within their individual capacity, they want to also be able to be a bridge between where you are and what venture capital investors are actually looking for. And again, the reason why they come in is they come in bringing a certain level of objectivity, where friends and family might be someone that they might empathize with you in various ways, or they might have a specific understanding in terms of what your business does. They have a subjective way of looking at that particular investment. So when you've got someone objective, it brings a certain level of validation to say that you have not only managed to gain traction and de-risk your business to your own subjective circles, but you've also been able to go out and raise some form of funding from someone who has got no relation to you. So that speaks to the actual business case in itself being something that someone saw and felt there is definitely an investment case here. And the gaps that angel investors fill, at times, your typical VCs might be too early. There might be a couple of things that they want you to get in place. You might need to have a specific amount of traction, whereas angel investors might come in a little bit earlier. But at the same time, they're not going to come in where there isn't some level of validation or ability for them to see the business case. Now, angel investors are different. You are going to get those that come in much earlier than others, and you are also going to get in those that come in at a later stage than others. And the whole point of having the angel investor coming in is it acts almost as a bridge between what, as I mentioned, VCs might be looking for, as well as making sure that you get your first objective investment capital, and that in itself enables the business to be de-risked to the extent that if you fail to raise money, as we all know, the chances of being able to raise money, so let me put it this way: if you have not de-risked your business from the ability to attract objective investment, it becomes very difficult for you to be able to get VC money. So that VC money is something that is later on, and you kind of have to cross that chasm or valley of death between your family or your own sweat capital to what it is that a VC would want, and that's the value that an angel investor actually supports you in being able to cross. And in that context, it actually increases the pipeline for the subsequent investors, which are more of your institutional investors. Now, it's good to go out and raise money, but not everybody who signs a check is someone that you want to take money from. And money in and of itself does not provide intelligence. Money in and of itself does not de-risk a business. It's important that whoever it is that you are inviting to be part of your company is someone who can add value beyond the money. And in adding value beyond the money, sometimes you get dumb money where someone thinks that they're helping, they're providing certain advice or guidance, whatever it is, but they can actually be damaging to your business. So you want to make sure that you are attracting the right type of investors within your company. So what they bring is, like typically with VCs as well, or any smart investor, they bring access to networks. But it's not just access to networks that bring you into specific rooms that you want to sell to. Sometimes your business might be struggling from a tech perspective. So you might ask your angel investor, network to say, okay, fine, this is what it is that we're building. We need someone to actually have a look at the approach that we're taking from a technology perspective. And then one of the angel investors might actually know someone. And the difference between institutional type of investors and angel investors is that you've got different individuals who've got different or multiple networks themselves. So that increases the number of people that you might have access to that you otherwise wouldn't be able to have access to. And secondly, that individual angel investor is not someone that is going to change, whereas sometimes within your entities or your more institutional structures, at one point, someone else is appointed, and that's going to be someone who might be the portfolio manager within that company, and that's going to be the new face that you're dealing with. Oftentimes, an angel investor is someone that stays, but we'll kind of touch on that again a little bit later on. And then again, the expertise that they bring is something that they bring from the world and their lived experience. So either whether they've worked in corporate or they've run their own business, or they've traveled the world and seen different types of businesses, that context is something that they're able to bring into your business in order for them to be able to guide you as you grow. And a lot of what happens is your mature angel investors or your mature investors have an ability to see what patterns within a specific industry exist, where things tend to go wrong, where the gaps might be, and they're able to kind of give that strategic advice in order to make sure that you're able to optimize on the opportunity and minimize on whatever risks. So essentially, they become a counsel or an advisor or a thinking partner to what it is that you are building and the journey that you are taking. So how do angels decide on who to invest in and not? It's largely instinct-based. As much as there is going to be evidence that the business must have, but because of the stage at which they are participating, it's something that is within them to say that, do I trust this particular business to achieve a specific outcome? And is it something that I feel I can contribute towards in some shape or another? Is this a sector that I understand? That's predominantly your more mature investors. Some earlier investors that are angels coming in for the first time, they have not yet refined that instinctual ability. So they're most likely going to be looking at certain elements of the business, but the instinct in itself will also come in to say, I think I can have, my investment into this particular entity because I think, this might be the outcome that they will achieve. Most importantly, and this is across investors, it's about the founder. And I think this is something that a lot of entrepreneurs may have heard from investors time and time again. It's all great to have a business that has, ticks all the right boxes in terms of traction and all of that. But if there can't be a relationship with the founder, and if the founder is someone who can't take a specific level of criticism, or when I say criticism, it's constructive criticism or a specific level of advice, then it becomes really difficult for an angel investor to participate in that investment. So the quality of the founder, and it becomes the critical linchpin in whether an angel investor will participate in that investment or not. It's largely a relationship building exercise that happens. And from a decision-making perspective, angel investors don't have to go to many people in order for them to know whether they want to invest or not. So the time frame for them to make a decision can be quite quick because, again, they own the decision. They're accountable for their own money. They're accountable for the decision. They don't have other LPs that they need to consider. So which does tend to fast track the process. But I will say what sometimes does slow down the process is if you've got a number of angel investors that are participating, and then people kind of get distracted doing their own things and all of that, and you kind of have to, chase them down from time to time. But that's the nature of the game, so it's not that the system in itself is perfect, but the time frames can be quite tight from presentation to when a decision is made to invest. And then what guides them is their own thesis. So a VC or an entity or an investment entity would have a mandate that they need to follow in guiding their investment decisions. And angel investors got their own inbuilt thesis to say that these are the types of companies that I'm looking to invest in. And whether it's something that's emotive, it could be literally emotional, where they just want to invest because they feel like they're doing a specific level of good. And some of it might be, literally building a specific portfolio that is going to have, certain outsized returns. It's very capitalistic in nature. There's no social element to it, but it is up to the own individual to dictate what it is that makes them invest in a particular opportunity. So earlier on, I mentioned that they are process-driven, or they invest using an institutional style approach. So there is an investment instrument that they would use, and typically, given the stage that they participate in, safes and convertible notes would be what they use to guide that particular investment. Why? It's simple, it's fast, it defers the valuation. And by deferring the valuation does not mean that there's no conversation that's going to be had around a specific valuation cap and specific justification in terms of why that particular cap, etc. That is going to happen, but you're not locking in a given valuation at that point in time when the investors coming in. Now, if an angel investor is investing at a later stage round and other investors are coming in via a straight equity investment, they too will also come in via an equity investment. So just because I mentioned safes and convertible notes, it speaks to the that actual round that the investors participating in. So if other investors are raising via straight equity, they're not going to have a different instrument that they use to participate in that investment. It's going to be aligned with what is being used within that particular round. And there's going to be typical terms that you will find in the safe or convertible note. Certain proratas. Now, with the prorata on the convertible note, that can be based on what the conversion would have entitled the investor at a particular point, right? At conversion. So they have the right then to retain whatever portion that would have been owned by them in order for them not to be diluted within a particular instance. But again, that depends on whether it was a post-money valuation versus a pre-money valuation, other conversation. Information rights, they do want to know what's been going on in the business. They do want to have specific idea of the certain metrics that inform the performance of the business in itself. Now, it's good for them to have that information so that they can track the performance, but it's also good for them to have that information so that they know when it is that they can come in and offer a specific amount of help, depending on whether the help is required, of course. And then you'll have your most favored nation clause that will come in, which essentially says that they also want to align with specific terms that other investors might benefit from later down the line. And when it comes to the asset class, as any investor would know, it's a highly risky asset class, early stage investments. So I think within the room, a lot of founders would not have succeeded with their first idea. First idea that you had, you may have thought it was great, and you may have thought you're going to make, this high level of success and all of that. And then later on, as you interrogate the idea, you realize that, no, it's actually not going to produce what it is. So just as much as you can have iterations of ideas which refine, it's the same context that an investor might have in terms of investing in one opportunity. It's not that opportunity that might necessarily make it. It might be the 10th opportunity that you invest in that will make it. And that's something related to what's called the power law. So a lot of the startups that you invest in, and it's an insight that every angel investor needs to have because they are risking their own money, is that the majority of that portfolio will fail, and then certain number of companies will return some money back and then some, but one opportunity is supposed to pay back that whole entire investment or capital outlay that investor would have put in. So that's something that a lot of angel investors are aware of. And that's also something that founders, in my view, need to be aware of, because you are in a highly, highly stressful environment. You're in a highly competitive environment. There's a lot of elements around the business that you have to consider. The failure rate in itself is high, given the 1 to 10 power law structure. It is a very high risk, not just for the investor, but also for the founders themselves. And the investor is there for a long-term period. So when it comes to startups, there's no dictating that an investment will exit or an investor will exit within 5 years. There's a target, and you can come in with intelligence that informs that target. You can align the startup in terms of how you are building it to make sure that that target is optimized to be met, but there's certain variables that are outside of control, outside of the founder's control, outside of the investor's control. The market at the end of the day is what dictates whether an exit will happen. So an angel investor is someone that has to be aware of that. You don't want someone coming and investing into your company and then putting their thumb against you to say, I want my money back, I need to exit. That is not the purpose of an investor. You don't need that pressure as a founder. There's a lot that you're dealing with, but at the same time, you do need the awareness that an exit is something that needs to happen at a particular point in time, and you are building a business that will be able to provide returns to the angel investor. So it's a long-term game, and it's a patient game, and you need angels that can actually be patient alongside you. And from a skin in the game perspective, you're not the only one that's bringing in skin in the game. As a founder, you want to have the ability to show the investor that you are fully committed to what it is that you're doing. right? You are not, having side gigs that are going to distract you from the business in itself, your income and your focus and everything and every amount of commitment that is required from an investor's perspective, you are putting into the business, right? And now that's exactly what an angel investor does. They are putting in their own money. They're putting in their own trust to say that whether this business makes it or not, I am by your side. I am with you for the long term. For the long term, there's no committee that's guiding their decision. There's no specific outside fund mandate that's guiding their decision. There's no LP that's guiding their decision. It's in and of themselves that dictates whether they want to invest that particular capital or not. It's a win-win. If you win, they win. If you lose, they lose. That's as simple as that. They're not going to have any management, management fees that they're going to be gaining from anyone. They're not going to be making any form of money for as long as the business has not produced what it is that would be expected from a viable exit. So this level of alignment is something that's rare, and a lot of people tend to think that angel investor money, is easy money to get, and I can tell you it's not. There's particularly from angel investors that actually know what they're doing. There's a rigorous amount of thinking and diligence that an angel investor still needs to go through, just as much as an institution would, but they do it within their own personal capacity. So how does an angel investor start to participate in a particular opportunity? So within our context, most deals are co-investment structure. So we come in as a pack. There's a number of angel investors that would assess an opportunity. And if that opportunity aligns with their own inbuilt thesis and market understanding and alignment, then they're happy to participate. But that's something that is guided by themselves. And the whole group makes their own individual decision. But then once the decision is made by the group, everyone participates in that investment. But within them participating in that investment, there's an opportunity to leverage that collaboration when it comes to performing things like due diligence, when it comes to identifying new opportunities to invest in. So there's a lot of social sharing and social engagements that tend to happen, and resource consolidation that tends to happen in order to optimize the process. And then, as I mentioned earlier on, you want to make sure that you've got intelligence coming in. So you get a group of intelligent parties who come from different backgrounds, different contexts, participating as investors into your business, with skin in the game into your business. So they're not just advising from the sidelines because, they might just be, sitting on a board or whatever it is. They've got actual capital in the business. They've got a vested interest in making sure that the business succeeds in the most optimal way possible. So that's the type of assistance that you get from that tribe that's coming in to support the business. And it's a syndicated model. So one of the things that you will hear is you don't want to have a cap table that's got 10 different individual investors coming in with smaller amounts of money or whatever it is. What you are looking for is a group of angel investors coming in under one vehicle, making sure that it's one entry point within your cap table, and that's that. And you don't want to have to speak to many different people when it comes to when it comes to any agreements or any signatures that you might need, or any approvals that you might need when it comes to moving forward. It's that one line item that will probably have one representative that speaks for the entire group. But that still gives you access to the entire group. Anyone within that particular syndicate, you've got access to at any given point in time. So they are on call when you want to speak to them, right? They're available to you when it matters. They're absent when it doesn't, leaving you the space to do what it is that you need to do. Because as a founder, their role is not to be operational in the business. Their role is not to dictate to you how to run your business. It is your business at the end of the day. But they need to be there. They want to be there when you need that advice. But from a founder perspective, you need to be able to call on them, right? Just because they're not knocking on your door wanting to find out, how things are going, et cetera, you need to be able to come to them and say, look, I need help with A, B, and C. does anyone have access to A, B, and C, or a specific type of individual? And that's the relationship that you build. It's literally dropping them a WhatsApp. It's not formal. It doesn't have to be. There are instances where it can be formal. So for instance, if you know that you need specific guidance in terms of your market entry into Nigeria, as an example, and there's someone who actually has that level of contextual understanding, then you might have specific regular, engagements in order to guide that particular process. So it is a cordial and a free-flowing relationship that you would have with that investor. And having an observer seat is something that angel investors will want to have. It could be one person who is representing that angel investor group, or it could be someone else that comes and participates at a particular point in time to kind of gauge what's going on. It does not give them a board seat to vote on specific decisions, but it kind of gives them that level of understanding in terms of what the business is doing. It gives them that context that they might need in order for them to be able to guide you in certain levels. And then from a governance side as well, that's always someone or a pool that you can tap into in order to help you with from a governance perspective. And as I mentioned, the best angel investors are on call. Don't have to have them scheduled in your calendar in order to meet with them. It's a relationship game. They want to build a relationship with you, and you want to build a relationship with them. And that in itself is a relationship that would outlast the investment term of that particular structure. And the whole game of it is that once you exit your business, this is a person that is within your network, and it's someone that you might be able to co-invest alongside, or it's someone that might invest in the next venture that you run. So from an angel investing in Africa context, there's a couple of things that one needs to be aware of. The gap is real. There's a lot more capital that is required in the space. Starting a venture capital outfit is a story in itself, right? Not every investor who wants to participate in the space has got the aptitude to start a VC structure. It's complicated. It's got a lot of it's a different story for another day. But nonetheless, this space in itself grows with more angel investor participation. As founders exit, mature markets have got those founders coming in and bringing in new context to new founders coming in and being that intelligent capital that's bringing in those new ideas and making sure that it's de-risking and optimizing their track to success. And the edge that local angel investors bring, it's all good and well having foreign capital coming in because there's a lot of context that they bring from a global perspective. But if you have investors that are operating in the market that you are selling in, where your service is being provided, where you are innovating, they're able to bring a specific lens to your business that you might not otherwise have. So it's important that within your considerations in terms of who you bring onto the cap table, you want to have someone who has some level of contextual understanding within that particular market, within that particular sector. There's always bigger pockets of money that are able or is able to participate with alongside angel investors. Angel investors are big on co-investments. So we co-invest alongside VCs, but there's also DFIs as well that we co-invest alongside who bring in those bigger pockets of money. So sometimes as a founder, if you are raising a specific size and a VC says or a DFI says that they're going to put in X amount, you can always go to an angel investor and say, this is the gap that we have. Are you willing to participate in this particular round? And that's a conversation that angel investors are always looking to have. And lastly, I mean, it's an ecosystem. It's the collaboration, the co-investments, the guidance, the advice. It's not just about you having one person or one entity that's helping you. It's about you being able to be plugged in to the ecosystem in the most optimal way possible. And that's what angel investors are bringing to the table. And that's what it is that they are supporting startups with. So thank you so much, guys, for your attention. And I am very open to your questions.
Thank you so much. You still had like 90 seconds to spare. So well done. Thank you so much. We will be taking questions soon. So while everybody's thinking about their questions, put them in the chat. I'm just going to ask Mr. Nick Allen to just take about just maybe 5 minutes at most to talk us through the build program, since Francois not able to make it today. So, Nick.
So I've only got 5 minutes. Is that all I get? Yeah, I've been waiting for
Yes.
this. All right. Firstly, Lundi, thanks so much for that. I mean, the reality is the angel investment component of this ecosystem is such an important aspect of early stage investment. You know, we're as a venture capital investor, we're in a situation where we can't invest until certain things are met, and having an angel investor coming into the opportunities that we're looking at is so important. And so, you know, the work that Jozi Angels are doing and the work that other angels are doing in South Africa and across the continent is so important. Thanks to Tabelo for setting this up, and then Tiki for making it happen. Really, really good. But my primary objective here is to talk about the build program. You know, we've been around for a long time, looking to support companies as they really start their journeys to commercial fame and fortune. And one of the things that we saw when we started investing commercial capital into the companies that we really liked, we'd work with the companies, see they're fantastic, but realized that they weren't quite there from a commercial investment proposition. So the build program was born in 20, well, the concept of the build program was born in 2020. And build is really about taking fantastic entrepreneurs and fantastic founders, really great ideas, businesses that are on the cusp of stardom and greatness, and helping them take those steps, put those processes in place that allow them to take that step to get the funding that they need to go on from there. The build program is now entering its fourth cohort. We've got support from local and international players. We've got a fantastic track record of businesses coming through our program in the past, raising significant capital and growing across the world. And Build Cohort 4 is now open for application. So if you're interested, you're building something really interesting, please go onto the Savant website, have a look at our build program, put your application in. Build is, if you know anybody building something really interesting, the build program is the first commercial steps in that journey. So please do join us. Tell your friends, tell your colleagues, tell your fellow founders that this is the place to be, and we'd love to work with you in making what you're doing the next big thing. Thanks very much.
All right, thank you. So any questions relating to build? We have 2 minutes for that, right? And then we have to then move back to the angel investors. So I see a hand up. I'm gonna take only 2 questions relating to build. So Simba, you can ask your question.
Hi, thank you. So relating to build, so if I'm not mistaken, Savant normally looks at hardware startups or deep tech. So what milestones do you
Correct.
guys probably look at when you're looking at the program?
We're looking for businesses that are probably at the pre-seed stage. That would be you've built something that is real. You've got a proof of concept. You've identified a client at the very least. That's the earliest stage that we're looking at. We're preferably looking for companies that have got some kind of revenue, but we've worked with businesses pre-revenue. We've got a number of very exciting pre-revenue businesses in Build 3, doing really interesting things. But you need to demonstrate that you've got something real. You've got clients that understand what you're doing. If you pre-product market fit, you haven't done your techno-economic feasibility. There's another program within Savant run by Tabelo, which is our Emerge program. But Build's looking for businesses that are really ready to take on some commercial capital, and we want to build you to that point where you can take on that commercial capital. Full disclosure here, guys, I'm in my kitchen. I thought this was fantastic. I'm cooking supper, so if I step away, it's because something's burning on the stove.
Thank you so much. All right, so one more question. Like I said, for build, we can only take 2 questions. Fourth element, you can ask yours, and then we have to move back to angel investing.
Hi guys, I hope everyone is enjoying their evening. A quick question. In terms of build, I've seen that we've got certain problems that, especially some of the guys that I've met along the programs, is that is it possible for me to say I get a client and the client is interested in the product? I get a client, this is what I'm selling to them. This is the innovation that I'm selling to them. They say, okay, we are interested in this innovation and then we'd like to purchase it, or we'd like to, you figure a way how to implement it. Okay, that's not a problem. Can I come to build and say, I've got this client that wants this certain device to be built within this specification. Can you help me with a code, how to in terms of building this and all that, and I just come in as a contractor or to implement the project, like especially for government, because government needs, when you give them innovation, they want to take it to tender and all these other stuff. So then I still need to get money to finance that, and then after I've implemented it, that's only when they pay me through a COD. So can you guys help to solve this mess?
So I think what's important is that understand that build is a very specific and very targeted program for businesses at a certain point. I think what we do across Savant is, because we work from very early stage, we want to work with businesses from ideation all the way to Series A, scaling onto the international market. So, if you've got something good, go onto our website, come and talk to us. If you're doing something interesting that resonates with us, we will find a place to support you. Tabelo's in Joburg doing the early stage stuff. So reach out to us, go onto our website. There are ways of getting in touch with us. And if it's not for build, there are other things that we do to support you in what you're doing. So certainly reach out and we'll see how we can assist.
All right, thank you so much. So now we are moving back to our questions. I'm going to just take the first 5 questions, and then Lundi, I'll give you a chance to respond to those. Then we'll take the next round. Actually, let's make it 3. So I'm going to start with the ones that are in the chat. So the first one is from Garabo. Returns follow a power law. That is interesting. Where can I read more about this?
Chat. Oh no, you said 3 questions. Let me wait for you.
Yes, that one. And then next one. Thanks. Next one. How common is it to have your investor also be your advisor? And is that combination recommendable? That's from Pumla. And then the last one is from Paul. Are you open to take applications?
Okay. Power law. I think it's something that you can look up. You can Google, I don't know. It's past ChatGPT. There's many options that you have in terms of finding out how that works, and then maybe you can just say power law portfolio theory. That might help kind of narrow the search in itself. But to put it simply, it's a law that says that out of 10 startups is a number. One can apply that to a percentage. One startup will pay for everything that a person has invested in. 6 startups would probably fail. You're not going to see your money coming back. I'll probably say maybe even more. And then the rest of those startups, you're going to see your money coming back. And then some maybe. But essentially, you need to have a good number of investments within your pool in order for you to actually have the returns that you're expecting. You can't invest in 5 startups and think that, you are going to actually succeed. But again, from a startup's perspective, it just goes to show how difficult it is to actually be a founder and how much commitment it actually takes from yourself. So it is a frustrating process that a lot of investors need to understand, and they can't add to that frustration. Just because they lose a specific, investment, it's not surprising. It shouldn't be surprising to them, and they shouldn't put, undue pressure to create the impossible out of certain startups. And then from an advisory perspective, so if you get an investor participating, angel investor, it is encouraged to have them as an advisor. But again, it's only encouraged if it depends on whether you are wanting to formalize them as a board within your board, then that's something that you can do. But I would encourage you to put them in that position only if they've got a specific qualifying criteria that allows them to be in that position. So it could be based on their market understanding. It could be based on their understanding of how to scale a startup. It could be based on the technology that they have, but they should balance the advisory pool that you have within your board. But when it comes to having them as ad hoc advisors, that's exactly what they're there for. And then there was one last question. Are we open? We are always accepting. We don't have a specific dates that we're saying we're open for receiving, applications for funding or pitch decks. We are constantly, open for opportunities. So at any point in time, you can visit our website, joziangels.co.za, send us through your information, and we'll look through it. And then if it meets the whatever criteria that aligns with the angel investors, then we're happy to engage.
Thank you. So the next 3 questions, Sibulela is asking, can I please get your contact details? And then the next question would be, how do angel investors evaluate deep tech or infrastructure startups that are still pre-revenue but have strong problem validation and systems thinking? And then the last question I'm going to take from a hand that's up, but I will be selecting somebody we've not heard from before. So Mohau, you can ask your question.
All right. Hi, Lundi. How are you, man?
Good, my brother. How are you?
Good. Thanks for the information that you've provided. I have 2 quick questions, really.
One question.
Well, okay, one question it is. I wanted to ask, what is the typical investment sizes that you see at angel rounds? And if you can just tie that up with maybe telling me what the usual traction metrics are for those rounds.
See what you did there.
Go ahead and answer those 3 questions. 3.5 questions, but okay.
Okay. You can get a hold of me on Lundi at joziangels.co.za. That's my preferred email address or contact method. You can reach out to me on LinkedIn as well. But unfortunately, I don't engage LinkedIn as much as I should. But yeah. And then from evaluating a startup that's pre-revenue, deep tech, etc. Look, one thing that you've mentioned in your question, you mentioned it's got some form of validation. So it depends on what that validation is. It depends on the quality of that validation and the extent of that validation. So what you mean by validation, obviously, is, and obviously happy for Nick to take this. And Nick, please do add on. So I think from our perspective, we are always looking at the markers, not just from a market perspective, but we're looking at the markers from the internal capabilities that the team has been able to demonstrate in how they've designed their solution, in how they've designed their journey in executing and providing the solution to the market. So we're looking at the thinking that is in place. We're looking at the market size that's available for that particular solution itself. So are the specific customers that we are able to engage with that would be able to say that this is indeed something that we want, and we want it for such and such a reason, and we're willing to pay X amount in order for us to be able to have the solution. We're looking for a clear understanding in terms of what it actually means from a capital raising journey perspective in order for you to be able to execute and meet whatever projections that you've put forward to us. So if you say that in year 5 or in year 3, you're going to achieve A, B, and C, and this is your fundraising journey, and we feel that based on the type of technology that you're building and based on the approach that you're taking, you're most likely going to need more. Now that tells us that you might not necessarily understand the extent to which you are supposed to build the particular product or position it within the market. So there's a whole range of elements that need to make coherent sense in determining whether or not that is an opportunity that we would invest in. But Nick, go ahead.
Yeah, thanks, Lundi. I think the reality is early stage hardware and deep tech is significantly hard. You know, it's significantly harder than software. I mean, that's the reality. But we're passionate about the reality in that hardware and deep tech are building the solutions that we live with. You know, we need physical products that solve real problems. You know, apps go so far, so we're very passionate about that. So from a Savant perspective, we're trying our best to build that process that will allow us to support companies all the way through the journey. I mentioned Emerge earlier. Emerge is about helping businesses get to the point where they get that they're able to attract those first maybe non-commercial checks. We work with the Technology Innovation Agency. We have a call that is likely to go out in the next not too long. Hopefully, Tabelo can tell us more about that. Just to support businesses to get to the point where they are attractive for that next round of commercial funding. We have developed Triple P, we have partners like the GIZ, etc. So yeah, again, reach out to us from a Savant perspective, to Tabelo at the very early stage, Francois at the middle stages, and then obviously from a funding perspective, that's where I get more involved.
And then on the last question around ticket size, so it varies. I mean, we've gone as small as 250,000 Rand, where a particular founder, needed to kind of close a gap, and we happily participated within that round. We've gone up to 5 million as well. So it does really depend. Generally, the range the average is around 800, 900,000. That's where we participate, but we are growing that with more angel investors coming in and more high net worth individuals coming into the space as well. And then from a criteria perspective, I think what Nick mentioned earlier on around the build program, it aligns, but it also varies based on what the individual investor's risk appetite is. So some want more traction than others, whilst others want clear validation from some level of market traction, whether it is 5 customers that you have, if it's maybe you're selling to small businesses, or maybe 100 B2C customers that you have, and you've been able to prove your ability to retain those customers. So it really does depend. But at the end of the day, what we're always looking for is a solution that's completely distinct from what's available in the market. It has to be innovative. It can't be a copy paste of something that is coming in from elsewhere. And you kind of just want to execute. So you need to have a full awareness of, certain dynamics that might not be applicable in the United States, or that might not be applicable even in Nigeria, in terms of what it is that you are bringing to South Africa, and vice versa.
All right. Thank you so much. So we're going to take 2 more questions this time. And then if we still have time, we'll take another one. So Paul, I'm going to ask you to unmute and ask your question because it's quite lengthy. Then once Paul is done, we're going to take Musa. Yeah, and then we'll answer those 2 questions. And if you still have time, then we'll be able to take another round. Paul, can you unmute and ask your question? Okay, if not, then we can have Musa ask your question.
Hello.
Hi, Musa.
Sure. My question is centered around the teams part. For me, I'm just a lone programmer. I build software in my house. I have no team. I have nobody I work with. The one that I'm building now, it's just me. So how do you deal with somebody like that? I'd like to have a team, but for now it's just been me for the for the past 9 months that I've been building this.
Okay, I'm going to summarize Paul's question so you can answer that. Runs a startup. They've been struggling to get funding. Now they have a partnership with the University of Limpopo, forming part of the TIA ecosystem. So they wanted to check if it's possible to have a call with investors, perhaps discuss a possible call with investors, and for entrepreneurs to be assisted. They're hosting a dev day at University of Limpopo and would like to have angels on board, as they do have pre-seed cohorts with early stage funding secured for them as well. So those are the two questions.
Got you. So maybe starting with the solo founder, which is typically what we would refer to as someone who is running their own business without a team. It is a bit of a challenge. I won't lie and say it's a straightforward answer that I have. It depends on a lot of things. Firstly, how much have you been able to achieve as a solo founder? Are you still pretty much building the solution itself? Have you taken it to market, and have you managed to kind of bring a product and prove within yourself certain capabilities that one might have needed a team for in order to prove? The measurement doesn't change because you are a solo founder. So certain principles still need to be in place. Now, as a solo founder, the other question is, when you are running a business, it's important for you to have different minds that are able to give different perspectives in terms of what it is that you're doing, and bring in specific types of expertise in terms of what it is that you're doing to optimize the business, and to make sure that it's thinking from a specific level of depth, So it becomes difficult for you as a solo founder to be able to have all those hats, and for the business to still be able to really operate at its optimal level. So that's always something that one would need to consider. And alongside that, your ability to not only speak to investors and attract investment capital, you also need to be able to attract co-founders or a specific team, right? And if you don't have the money to pay them, you need to have the interest to give them some level of equity participation within the business. Now, you have to be smart around the type of equity, how you structure that equity participation. You don't want to convince someone, to be part of your business, and then you realize you actually don't gel, and then now you're stuck with someone who's got equity in your business. So you want to make sure that you provide a viable structure for that equity participation. So typically, a share vesting agreement is something that you might have in place, with clear deliverables that that particular individual would need to meet. So that's something that you would need to have. But long story short, at some point in time, you will need to have a specific team around you. You will need to have gone and convinced other people to be part of that, your business, and to be able to assist you in the journey that you're on.
Okay.
Yeah,
And then the other question.
Yeah, what was it again? Please just repeat it.
It was partnership with the University of Limpopo,
yes.
looking to get
Got you.
investors on board.
Yeah. So look, we are always keen to look at where there's pockets of innovation happening, wherever that may be. And this is actually a conversation that we had with Tebelo as well. There's a lot of spaces where innovation is taking place with insufficient investor footprint. And that's also where we want to be. That's also where we want to go. Now, with that being said, when it comes to innovation that's happening in universities, it depends on what it is that's being built. It depends on how far along the way that particular innovation is, because sometimes with universities, there can be a research and development cycle that just keeps on going without a clear path to commercialization. So we want to make sure that we're not funding research, but we're actually funding a business that has got the mechanics to be commercially viable, not in 5 years' time, but something that can be commercially viable within a shorter space of time. So that's something that we would always be looking for. So we will find certain businesses that are further along, of course, than others, and there will be those that are not. But that pool is a pool that we definitely do want to participate in. Traveling to Limpopo, definitely, for sure, from time to time when the opportunity arises. But obviously, there's certain constraints sometimes that, get in the way in terms of traveling beyond, one's general geographic location. But with online engagements these days and all of that, always happy to jump into sessions with various universities in various areas in order for us to be able to add input and to understand what's going on.
All right. Thank you so much. I'm going to hand back to Mr. Tabelo to close off the session. That's all the time we have today. So, Tabelo, over to you.
Yes, thank you. And thank you, Lundi, for delivering what a good presentation and very informative. You could see from the charts and the questions that came in that people really enjoyed the session. And Nsiki, thank you really for facilitating the whole webinar and the ones that are still to come. Nick, the answers that you've put through there, good. We always appreciate it. Maybe the one message that I always leave at the end of the session is for founders to understand that money will always follow opportunities, not the other way around. So how investors make money, it's investing in great opportunities. So it's in the best interest of investors to deploy funds. And I know that there is a general feeling across many founders, and I speak from experience, that there isn't enough funding in South Africa. But sometimes it's more of understanding what it is that you're selling to your customers, but as well to the investors. Because when you approach them, it's more about what you can give them rather than what you require. So it's very important that we do understand that. Let's demonstrate opportunities, and obviously funders will come in. Very important for us to understand the different funders in the funding landscape, the government in terms of DFI, non-dilutive funding, angel investors who comes early, then VCs. And with that said, within Foundry, as Nick has mentioned, we have different opportunities. So it's 3 products. The first one would be the broader incubation that we do offer across companies that whether with prototype or early revenue. We do that through our partnership with SEDFA, which we do bring in those companies to come in and we assist you with integration into the entire innovation ecosystem or funding ecosystem. Our second one would be our partnership with Technology Innovation Agency. There we extend non-dilutive funding, which is mostly grant, to companies that are coming to us with, call it desktop prototypes until they get to market. With the Emerge program, which is an accelerated program for about 4 to 6 months, it's what we deliver through our partnerships with the different corporates, where we bring in founders with validated ideas that are looking to quickly build an MVP and get to market and validate their product. The idea is to ensure that we can de-risk companies so that players like Mr. Lundi Njomane and Nick can see opportunities in that, because the idea is to ensure that you're putting money in companies that have at least a potential to succeed. I've gone off with 4 minutes. Thank you to everyone. We really appreciate your presence and making the time. Until next time.
Thank you so much, guys. Thanks, everybody.
Thanks, everyone.